Sandra finished paying off her mortgage on a Tuesday afternoon in October 2022. She had been making extra payments for 11 years. Anywhere from $200 to $600 a month, above her minimum. Whatever she could squeeze out after groceries, utilities, her daughter's school supplies. She kept a sticky note on the refrigerator, a running tally of what was left on the balance. Every few months, she crossed off a number with a Sharpie and wrote a smaller one underneath. The day the balance hit zero, she cried, her husband opened a bottle of champagne they'd been saving for exactly this moment. Their daughter took a picture. They called Sandra's mother, the woman who had told Sandra for 30 years that paying off the house was the most important thing a family could do. Sandra had done everything right. She had followed the advice her parents gave her, the advice their parents gave them. She had been disciplined, stayed focused, sacrificed the vacation upgrade, the extra contribution to her retirement account, the occasional indulgence, all of it, to watch that number on the refrigerator shrink. And in doing so, quietly, methodically, over 11 years, she made one of the most expensive financial decisions of her life. Not because paying off debt is reckless, not because her mortgage wasn't real, but because of what she gave up to do it, the money she didn't invest, the compounding that never started. The gap between what Sandra has today and what she could have had is nearly $500,000. There's a name for what happened to Sandra. It's called the opportunity cost trap. And if you've ever made a single extra mortgage payment, even once, you need to understand exactly what it cost you. Right now, in 2026, tens of millions of Americans are doing exactly what Sandra did. Maybe you're one of them. You refinanced in 2020 or 2021 when rates fell to historic lows. Some of you locked in at 2.65%, some at 2.9%, some at 3.1%. You felt smart. Because you were. The system handed you the cheapest money in American history, and you took it. But then somewhere along the way, maybe after your dad said the same thing he's been saying since you were 18, maybe after a podcast told you debt is a moral failing, you started throwing extra money at that mortgage. A few hundred here. A lump sum at tax time. Just to get rid of it faster. Just to own it clean. There's a whole industry built around this feeling. Dave Ramsey built a media empire on it. Millions of people have followed the baby steps, called in to do their debt-free scream, and felt genuinely proud. And they should feel proud. The discipline is real. The sacrifice is real. But the math doesn't care about the feeling. And the math, in 2026, is telling a very different story than it did in 1995. The S&P 500, the basket of 500 of America's largest companies, has returned an average of 10.5% annually since 1957. Over the last decade, that number climbed to 11.3%, not every single year. Some years are brutal. 2022 was painful. But over the full length of a 20 or 30-year mortgage, the market has never once failed to beat a 3% interest rate over any comparable window. Your mortgage, especially if you locked it in between 2020 and 2022, is not the enemy you've been told it is. At 3%, it is one of the cheapest sources of capital you will ever have access to in your lifetime. The banks understand this. The wealthy understand this. And the advice your parents gave you, sincere as it was built for a world where mortgages cost 10, 12, even 18% a year. That world is gone. The advice stayed. And the gap between what you have and what you could have is growing every month you send that extra check. The advice has a history, and it's a long one. When your parents and grandparents were building their financial lives, let's say 1965 to 1990, mortgage interest rates averaged between 7 and 12%. And in 1981, the average 30-year fixed-rate mortgage hit 18.63%, 18% per year. In that world, paying off your mortgage fast wasn't just emotionally satisfying. It was mathematically urgent. Every extra dollar you put toward principal was saving you 18 cents in guaranteed interest every single year, forever. There was no investment in the world offering a guaranteed 18% return. Paying off the debt first was the smartest thing you could do. So the advice was correct. It was built for those numbers. It made sense. Then the world changed. Between 2000 and 2021, the Federal Reserve, the institution that sets the cost of borrowing across the entire American economy, cut interest rates again and again after the dot-com crash. After 9/11, after the 2008 financial crisis, after the pandemic, each time the stated goal was the same: keep the economy moving, keep money cheap, keep Americans borrowing and spending. By January 2021, the 30-year fixed mortgage hit 2.65%, the lowest in recorded American history. Freddie Mac data shows approximately 14 million households refinanced in 2020 and 2021 alone, millions of them locking in under 3%. They were handed, essentially, the cheapest money this country has ever offered a working family. And millions of them, following advice written for a completely different century, started paying it back as fast as possible. The rates updated. The conventional wisdom didn't. And that lag, between what the world became and what the advice still says, is where hundreds of thousands of dollars quietly disappear. Let's talk about the actual mechanism, because this is where most people's instincts get it exactly backward. Say you have a mortgage at 3.5%. Every extra dollar you pay toward that mortgage saves you 3.5% in future interest. That is your guaranteed return on that dollar. It's real. It's locked in, but it is 3.5%. Now take that same dollar, that exact dollar, and invest it in a low-cost S&P 500 index fund instead. Based on the historical average going back to 1957, that dollar earns approximately 10 to 11% annually, compounded, not guaranteed in any single year, but remarkably consistent across any 20-year window in market history. There has never been a 20-year period in S&P 500 history where a diversified investor lost money. The spread between those two outcomes, 3.5% versus 10.5%, is where the gap lives. And over time, that gap becomes a chasm that no amount of disciplined extra payments can close. Here is the specific number, and it's worth sitting with. $1,500 a month in extra mortgage payments, sustained over 20 years. You pay the house off faster. You save real interest. You feel the progress. It registers as a win. $1,500 a month invested in an S&P 500 index fund over 20 years at a 10.5% average annual return. You keep the mortgage, you make your regular payments, but you grow something on the side. The difference between those two outcomes, same person, same $1,500, same 20 years, is $490,000. That is not a rounding error. That is a retirement account. That is a child's full college education. That is the financial breathing room that most working Americans spend their entire lives trying to find. And it was available to them the whole time, in the spread between their mortgage rate and the market. Here's the counterintuitive truth the financial industry almost never says plainly. A low-rate mortgage is not dead in the traditional sense. It is a leveraged position on your future. You borrowed money at 3% to live in a house. While you pay that loan back slowly, your invested capital is compounding at 10. The 7-point spread between those two numbers, every year for 20 years, is where real wealth is built, or quietly surrendered. The people who understand this system do not pay off low-rate mortgages early. They invest the spread. Let's bring this out of the abstract and into your actual financial life. Because the abstract is easy to nod at and dismiss. The personal is harder to look away from. If you have been making $500 a month in extra mortgage payments for the last 10 years, and many disciplined, hardworking Americans do exactly this, and your rate was 3.5%, here's what the math says. That extra $500 saved you roughly $21,000 in interest over the decade. That is real money. That's a solid vacation fund. That's a used car. That is not nothing. But that same $500 a month invested consistently in a low-cost S&P 500 index fund for 10 years at an 11% average return would have grown to approximately $107,000. The gap, $86,000, not lost to fraud, not lost to bad timing or bad luck, lost to the feeling of security, to the emotional reward of watching a balance go down, to advice that was correct for the world your grandparents inherited, and quietly devastating for the world you actually live in. Now extend that same logic to 20 years at $1,500 a month, and you're back to $490,000. There's another layer to this that nobody discusses. Home equity, the wealth you build by paying down your mortgage, is one of the most illiquid assets you can own. You cannot spend it directly. You cannot access it quickly if you lose your job next month. To convert that equity into cash, you either sell the house or borrow against it, which means paying interest again on money you already paid in. Your equity is trapped inside the walls. It cannot move. It cannot respond to a medical bill, a gap in employment, an opportunity that arrives on short notice. An investment account is different. It is liquid, accessible. It moves with you through the unpredictable transitions of a real life. A paid-off house gives you the feeling of ownership and security. But the equity inside it cannot do anything for you until you give up the house or borrow against it. The real mortgage cost isn't the check you send to the bank every month. It's the compounding you never started, the $490,000 that grew in a different account on a different path, while yours stayed locked inside the walls. None of this is a case for recklessness. None of this means debt doesn't matter, or that the piece of a paid-off home is worth nothing. For some people, those carrying a 7 or 8% rate, those close to retirement without a long enough time horizon for the market to recover, those for whom the psychological weight of debt genuinely impairs their daily life, paying it off early can be the right call. Those factors are real. This is not one size fits all. But for the millions of Americans sitting on mortgages at 3, 3.5, even 4%, locked in during that historic 2-year window, and sending extra money toward the principal every month while their investment accounts sit underfunded or empty, the math has a question it wants to ask you. Your parents told you that owning your home outright was the safest thing you could do. And in their world, with their rates, their market, their era, they were not wrong. The rates changed. The opportunity changed. Millions of Americans were handed the cheapest debt in history and responded to it the way their grandparents would have, by running from it as fast as possible. The only question left is whether the advice should have changed with it, and whether, for you, right now, in your specific situation, it already has. If you made it this far, you already think differently about this than most people do. The topics on this channel aren't about quick wins or market predictions. They're about understanding the systems that quietly shape your financial life, so you can stop being surprised by them. If that's the kind of content you want more of, subscribing takes 2 seconds. I'll see you in the next video.